What is happening? All right. Here we go, baby. We're here on LinkedIn Live. We're here on TikTok Live, and we're here on YouTube Live. I'm Zach Rasinger. I help my clients buy, sell, and lease commercial real estate, and I am here to walk through a few questions for you. We've got the green screen going here on the TikTok Live here. Flip that off. All right. So let's jump into it. I've got a few questions that have come up through LinkedIn, through TikTok, and through Instagram, as well as YouTube. I thought I'd just fire off a few answers to some questions here. If you have questions, you want to type in the answers down below. I'll answer those in the next session. We're doing TikTok Live in the morning as well tomorrow. So if you have not already joined the CRE Pro Network, please do so. You can see down below the ticker tape is showing you the address for it. So let's jump into it. First question, what factors should a business consider when choosing a location for their commercial property? Good question. Here's the answer. The answer should typically be location, but that comes with a caveat. And by that, I mean the location is only dependent if the rest of the factors are of consequence. So if you have the best location but not the right fit for your business, demographics, building size, traffic flow pattern, it could have to do with symbiotic relationships. It could be the whole SWOT analysis, right? The strengths, the weaknesses, but more so the threats. What business can cannibalize your own? It's the same reason that the QSR business doesn't, in fact, allow for too many in the same location. So that's a big concern. Outside of that, let's jump back on here onto the TikTok Live. Let's go with the background here. Not the enhance. Maybe I can't do live. I guess not. You just a filter. Okay. Good to know. Maybe I can. No, I think it has to be. All right. Down. All right, I'm going to turn off the background. There we go, a little bit better, a little bit cleaner. Okay, so yeah, all of the. All right. All right, now we're totally live. I'm Zach Rasinger. This is CRE Pro Live. This is commercial real estate brokerage. It's everything to do with commercial real estate brokerage. I'm in Austin, Texas. Where are you from? Shoot me your location. If you've got comments down below, if you've got questions, I will answer them primarily about commercial real estate. And my whole thing is do what you love to do. And if you can make a living at it, fantastic. If that, it oftentimes will turn into something that you can end up making a living from, even if you can't in the initial stages. So hopefully these questions and answers will help you out. If you're looking to go down the track of commercial real estate, if you are thinking about investing in Austin, Texas, if you have a business, this is a great opportunity. Fire off some questions. Where are you from? Where are you now? And have you worked in commercial real estate before or brokerage? Have you invested? Do you own your own home or are you renting? All these are important questions as you're thinking about what your next step is in terms of your real estate investments or other investments. What can you invest in that is going to beat the rate of inflation? And also, what can you invest in that's enjoyable for you, right? I mean, if you're investing, that's why I think that things like Bitcoin or or stocks or something is interesting, right? Investing in currencies, maybe that's your thing, or something that is tangible that appreciates over time. Vintage cars, or I don't know what else. What else out there? What do you invest in that helps you uh, find find interest or find value in what you're in interest, what you're investing in, outside of just the pure escalation of the arbitrage between where you bought it and where you're going to sell it, or what dividends it provides along the way. So some of the things that I think about when I'm trying to decide, like, all right, where am I going to look for deals, particularly here in Austin, Texas? Things are going haywire, right? Things are going crazy. It's hard to tell the value of things. We have, at this point, the most overinflated housing market in the country. And what does that mean? Well, during pandemic, houses went from an average of roughly $250,000 to around $450,000. That's just a liquidity thing, and now we're seeing the repercussions from that. But what does that mean? What does that mean to you as an investor? Where do you start to look for deals? Well, don't look in inflate. Don't look in inflated markets. Don't look where everybody else has invested, and now they're dropping the knife. Say we say catching a falling knife. You don't want to catch a falling knife, and by that I mean you want to invest in markets that are going up. So how do you do that? Well, let's get into a few of the questions that we've been asked. So, what is the current economic climate, and how does it impact commercial real estate trends? Well, as we all know, we anticipated interest rates going down. Uh, Let me know out there if you have heard anything different. But the Fed notes, Fred, was released today, and it indicates that there won't be a decrease in the interest rates this time, nor in maybe June, and maybe the first one will be in September. It's a huge counter to what we heard was going to happen in the beginning of the year. Everybody was saying, "Oh, great, they're going to go down. No questions asked. Election year." I can say I was one of those people, but at this point, I don't know. So, what's the current economic climate? I think we're sort of hitting a new normal. So if you think about it, like we were all considering for the last 2 years at least, deals have been just cratering because of financing. And with a stabilization, we tend to get more normalized deals, which is a good thing. As we get a more normalized deal, calculations and models can reset. What does that mean for you, an investor? Well, we tend to make a lot of our money in the times of fluctuation and price mismatching, right? So at this time, because people often need liquidity, they're willing to sell for maybe less than they normally would, because they haven't been able to sell up until this point. You can start seeing this a lot of the housing market, right? That people who had not been getting offers before, even though interest rates haven't changed, are now getting offers because they say, look, I have to buy, or I'm making a right offer at the right price for me. How does zoning affect the use of commercial properties? So zoning is the regulation by the municipality of what you can or cannot do in a certain area. And that has to do with how the city wants to shape the direction of the city. So places like Houston have no zoning. It sounds crazy, right? But that also means that there might be a liquor store next to a home, next to a strip club, next to a cash checking place. And so it doesn't create consistency. It's just how they decided to lay out their city. And the problem with that is that, the good thing about that is that it's not restrictive. The bad thing about that is that zoning prevents or helps growth of a neighborhood in a particular direction. So when you don't have that, then you run into a big problem. If you have questions, fire them away, because I've got some here. If you're in commercial real estate, reach out. If you if you can join as a live guest, in other words, if you have 1,000 followers and you want to join as a live guest, you have some questions, you want to contribute, let me know. I'm more than happy to bring you on, share you with my network. We're also on YouTube right now, so YouTube Live, Instagram, and we've got followers all across. all across the country and all around the world. So advantages and disadvantages of investing in retail properties. So a retail property is what you would think of as like a shopping center or a retail center. Anything that is producing income through the sale of items. That would be a shopping center, be a standalone. It might be a QSR fast food restaurant. There's a lot of retail aspects out there that, anywhere you really go, any epicenter that consistently produces goods for people, those are retail investments. And those retail investments tend to produce a cash flow right now. And the cash flow and the cap rate of those assets are around 7, 8, 9% cap rate. The cap rate is the net operating income divided by divided by the property price, divided by the asking price, divided by the value. Depends on what number you use in the denominator. Typically, it's your return on the money on in a single year. It's your percentage allows you to create an apples to apples scenario to some extent. And it's used by commercial real estate investors to compare to like assets that are adjacent to each other. It doesn't really make sense if it's outside in a different geo, or if it's a different asset type. It really doesn't, it's hard to say, because when you're talking about two assets that are similar in the production or in the trajectory of where they're going, essentially in the growth of the asset. When that happens and you compare two assets that are the same, then cap rate makes sense. When you're comparing something else, you might want to use a cash on cash return. That's essentially the amount that you'll get back at the end of the year, the amount that you earn over the year in a percentage on that asset or any asset that you invest in. What are some of the advantages and disadvantages of retail? Got that. How do market conditions influence the value of commercial real estate? So how do market conditions influence the value of commercial real estate? Well, like all things, we are investing for the long term, and by that I mean long-term capital gains investment. So when you're investing in a commercial real estate property, it's typically not a buy and hold or buy and sell immediately. The reason that I say that is that you will lose out on the capital gains advantage of investing in real estate. So unless it's a great deal, unless you're fixing and flipping and you are borrowing money at a very high interest rate, you have very little motivation to sell at any time before a year of holding the property. So there are some disadvantages to trying to time the market. If you can buy and hold and not sell, as many investors believe is the best way to do it. If they don't have to sell, they don't sell. They can, if you need to free up liquidity, the best way to do that sometimes is to lever the property to the fullest extent. So by that, I mean, if a bank will allow you or a lender will allow you based on a few things, your credit would be one of them, the income coming off a property, if it's income producing, or the value of the property. Those are the three different elements. So your credit, your LTV, or your loan to cash. How do you assess the risk associated with investing in commercial real estate properties? I think it's a lot of due diligence. It's a lot less risky than most assets. It's, I would say it's a little bit. It depends on how you're doing it. So if you're investing in commercial real estate and you have a thorough background and knowledge in it, and you understand that due diligence is key, and that you need to utilize the law, the zoning, the regulations, the trends in the market, you understand that there are ways to apply for and prevent maliciousness and so on. If you understand that there's a risk involved to it, then it's not a very risky asset compared to something like gold, for example, which I think is very risk adverse. and Bitcoin would be the other side, right? They're great harbingers when we're talking about the fiat currency, the dollar, but they're also gold can be pretty stable. Any sort of precious metals over time, bonds, those are all very stable assets. Whereas you're talking on the complete other side of the spectrum as something like a cryptocurrency or I don't know futures. Um, so that's where I think that the risk it sets somewhere near the low end of the spectrum of risk, but with a lot of things, particularly for commercial real estate, the more that you can remain vigilant and the more due diligence you can do getting into real estate, the better off you are going to do. That doesn't exactly apply for things like gold. It may not even apply for things like investing in the stock market. Particularly if you do it in a large basket currency or large basket of funds like an S&P 500, um, you know, you don't have to invest or do the due diligence on all 500 companies. You just invest in the Vanguard fund and you can set it, forget it, and hopefully it grows over time. All right. Who we got here? Who has some knowledge in real estate? Who in the room has knowledge in real estate? Where are you from, and what's your knowledge in real estate? Hit me up in the chat, and I'll select you to jump on. What is this thing up here? Oh, frequently asked questions. Setting a goal. Boo. Get out of here. Okay, here we go. Fair enough. Get out of it. All right. What else we got? Okay. What are key considerations when negotiating a commercial lease agreement? Okay, so commercial leases are actually pretty complicated. I am going to advise you, if you have not done a commercial lease in the past, get with a commercial real estate broker who has, because they can be very complicated. There are a lot of nuances to them, and particularly if this is your first one, right? I mean, I went through this today with someone I partner with, and this is their first commercial lease. So what do you look out for in a commercial lease? What should you be looking for, and what sort of pitfalls are there? What sort of negotiation tactics can you use? But also, what kind of opportunities are there in order to what levers can you pull in order to change the outcome? As we're talking about a commercial lease. Well, okay, let's think about it. In a purchase, you've got a few levers that you can pull. It's usually money or time, right? Because either you make a higher offer with a higher earnest money and a higher option money, and maybe there's more option periods and whatever. The other one is time, right? How quickly can you close, and how many delays to that closing are there or could there be that would allow the buyer to get out of it? So a financing addendum, for example, an environmental addendum or an amendment. Anything that would prevent the closing from happening, or anything that would delay the closing and not make it as expeditious as possible. Those are the levers that you can pull as a real estate broker or as a buyer or seller in the purchase process. When we're talking about the lease, it gets really complicated on the lease. And the reason I say that is because there's so many moving parts, and it's an ongoing relationship. If you think about a purchase, when the purchase is over, all four of the parties will split and go different directions. And in fact, that's probably 6 parties total, right? Buyer, seller, broker, title company, and the financing arm, however that comes together. So that's that. I mean, out of a traditional purchase agreement, we've got 6 different parties. 6. When we're talking about a lease, now it gets really complicated because you have not only the owner who might decide to sell the property later. You have the brokers on each side, tenant rep, landlord rep. You have the company or the tenant, and if they have an internal structure, then there's more decision makers involved there. So it's like usually, I mean, it's infinite number of people that are involved in a decision like this. So how does this change how we behave? How does this change how negotiations happen? Well, good question, Joel. Um, the way that this changes everything that we're working on inside of the commercial lease is that you have to be most vigilant on the things that matter most to your client. Well, how do you do that? Well, my number one suggestion is to utilize AI today. So take your client's information, put it into ChatGPT, and say, okay, what should I be looking out for when I am structuring a lease for this tenant here? And it will come up with a list of things to say, okay, maybe watch out for X, Y, and Z. Watch out for, offer this rate and then drop a rent bump on it, escalate it over time. That may be an option. So there are a lot of aspects that need to be watched out for on a commercial lease. Just like, if we just talk about high level, a traditional purchase and sale agreement is probably 8 pages. The traditional lease is 18 to 26 pages. I think I was just reviewing a lease today. It was over 30 pages, and that's just a normal lease. There's nothing unique about that. So yeah, I mean, just think about it. The complexity goes up, the risk tolerance goes up, but also your value as a broker goes up, your value as an investor goes up, your value as a tenant goes up. All of those things and above, if you learn how to maneuver, negotiate, and ultimately close at a term or rate that makes sense for you and your client. All right. What are the main factors that contribute to the depreciation of commercial properties? So depreciation happens, straight line depreciation happens over 39 and a half years. Essentially, that means that the depreciation of a building, according to the government, means that, or the IRS, means that the building will be depreciated over those 39 and a half years at an equal rate per year over that period of time. When we're talking about depreciation, we could also be talking about accelerated depreciation, or we could talk about cost segregation. Both of those things come up quite frequently, and they are each very interesting elements when we're talking about commercial real estate and investment, particularly if you have a tax incentive to either accelerate the depreciation or to segregate the cost. So both of those things are a topic all in themselves. But how does depreciation work in commercial real estate properties? Well, it helps in terms of lowering the base value of the property, ergo what you pay tax on every year. So it affects the building, the depreciable value, and you're gonna a lot of times see somebody that has held a building for 40 years, and then at the 40th year they're going to sell. So here's a business idea, and I see this come up all the time. Find all the owners that have held property for 38 years. Reach out to them and say, hey, you're about to hit the end of your useful life of your building. The clock restarts, by the way, for the new owners. So if they haven't sold already, or they haven't recapitalized, or they haven't, I guess you could probably sell from one entity to another and reset the clock. And then take the accelerated depreciation again, and so on and so forth. Maybe, I don't know. You tell me if you're out there and you have any idea about accelerated depreciation. Hit me up in the comments, or join me live here. How do you evaluate a potential building for appreciation in commercial real estate investments? Do not buy on appreciation. That is my suggestion. Just because it's so hard to calculate where the trend line is going over time. I guess if you try to buy, it's like trying to buy on the dip, right? It's extremely high. It's extremely difficult to do. And what you want to do is make money on the buy. As they say, make money on the buy. What does that mean? Well, that means get a good deal. So even if things go sour, things go negative, things go, you plan and you underwrite it conservatively. What does that mean in terms of your overall profit for the long term? Well, it just really depends. In terms of planning for appreciation, I say don't do it. plan that the building, in fact, decelerates in its growth. Be extremely conservative and buy in terms of make sure that you buy with a amount already built in that if things go well, it will hit an anticipated current value. So you want to buy it under market rate, essentially. What are the main types of financing options available to commercial real estate investors? I'll just go through a few of them. If you have more, drop them in the comments below. If you work on financing, if you have experience, if you have used commercial real estate lending in order to buy, sell, or lease commercial real estate, let me know. Okay, so let's do this. Here's what we got. We've got conventional financing is essentially banks. It's lenders. It's maybe if you have a mortgage, that would be a conventional lender. We have alternative lenders, so private money. A group, and this is less regulated. So we go from the most regulated, which is be an FDIC regulated bank or lending institution, where they're taking on investments from the community. They're putting it into a big pile. They are able to lend 90% more than they have, right? So if they take $10, they can lend out $90. They do that by lending it out to investors or to well, I guess to a lot of people to spur growth in the community, and that had to do with coming off the gold standard, I guess. So yeah, they lend out the $90 and they collect interest on that, and they pay out, in theory, either investors or they pay out on the money market account, or they pay out on the CD or whatever they've offered. Okay, so that's conventional financing. The next one we're talking about is private money. So in the same case, people take their money, they give it to a private investor, and that group lends that money out at a rate that is traditionally higher than a commercial or loan or a conventional loan. And of course, there's a lot of different lending programs that are out there. The biggest and most utilized one in commercial real estate is the SBA loan. SBA loan tracks with the current market. So as the market is high today, an SBA loan is going to be at a high interest rate. That interest rate is typically 3% over prime. So that's about 11.5% right now. So not a great deal, but if it's going to fuel your business, I mean, you just got to make a decision. Okay. What else we got? How do changes in local infrastructure impact the value of commercial properties? Well, so here's a great example. When a road goes right by your business and you stop at a stoplight on a hard corner and you run let's say it's either a gas station or a QSR, a fast food restaurant, it's really great to have all that business stop and at the light, and they see your huge golden arches or your sign, your gas station sign, your current rate for gas or whatever it is. When the infrastructure changes and there's a flyover that bypasses, we call them a flyover, but that bypasses your property, and people are no longer stopping there, well, it completely devalues your business. So it can either increase or decrease the value of your property almost instantaneously. So how do you benefit from that? Well, one way is to watch and monitor what's happening in terms of where they're putting stoplights, where they're putting overpasses, where that business or where that traffic will flow out to, and where it's coming in from. All right. What is the impact of e-commerce on the demand for warehouse and distribution space? Really great question. I'm sure you all love to hear this. The great thing is that with all the nearshoring that's been happening recently in the United States since the pandemic, we have seen a gangbusters level of interest in the warehouse flex industrial space. And the reason for that is because we're starting to see a lot more e-commerce and distribution, last mile services happening in the United States, and so it's going crazy right now of how many people are now bringing their business to America, onshoring it, and either assembling, manufacturing, or just simply distributing from here in the United States. It's a fantastic aspect of what's happening currently in our culture. So, of all those things, what to you is most important that's happening, and how is it changing how you are working your business right now?